Have you ever been scanning a company's financial report and just stumbled on that line item, deferred income tax? It kind of sounds complicated, right? But believe me, it tells a really fascinating story about where a company's been and, more importantly, where it's headed. Today, we're going to pull back the curtain and decode it together.
So let's start with a puzzle, one that trips up even really savvy investors. You're looking at a company, it's clearly profitable, but the tax expense you see on their income statement, well, it just doesn't seem to match the actual cash they paid in taxes. Now, your first thought might be something fishy's going on, but this isn't about tax evasion. It's all about accounting. And to get to the bottom of this, we're going to follow a 5-step path. We'll start with this idea of a tale of two books. Then we'll see how a great timing mismatch causes all the confusion. From there, we'll uncover these clever things called the accountant's IOUs, find the clues on the balance sheet, and finally, we'll wrap it all up with why this tax tale matters for you.
Okay, so the whole story really begins with a fact that might surprise you. Companies, for all intents and purposes, keep 2 sets of books. And before you get any ideas, don't worry, both are perfectly legal. In fact, they're required by law.
And here's the heart of the matter. See, the books they show to investors, their whole purpose is to give a smooth, clear picture of how the business is actually doing. We call this accounting profit. But the books for the tax authority, they have a totally different goal. They're all about following the letter of the tax law to figure out what's legally owed. That number is called taxable income. Different goals, different rules, and yep, you guessed it, different results.
So that's the what. But what about the why? Why do these two numbers split apart? Well, you'd be surprised. It almost always comes down to one simple thing: timing.
And the number one culprit, the biggest reason for these timing differences, is something called depreciation. It's just the fancy accounting way of spreading out the cost of a really big purchase, like a new piece of factory machinery, over its useful life. Let's make this super clear with an example. So, a company buys a machine for £20,000. For investors, they want to show nice, steady profits, right? So they might spread that cost out evenly over 10 years. That's a £2,000 expense each year. Simple. But the tax rules are different. They're often designed to encourage companies to invest. So they might say, hey, you can write that off faster, let's say in 7 years. Well, check out what happens. In year 1, the expense on the tax books is way bigger. This makes the company look less profitable to the taxman, which means they pay less cash in taxes. For now, it's a short-term win.
Okay, so you've got this gap between the tax paid now and the tax that's going to be owed later. How in the world do accountants keep track of all this? Well, they came up with a really brilliant system. Basically, a system of IOUs that shows up right on the balance sheet.
So, first up, we've got the deferred tax liability. Remember how our company used that faster depreciation to pay less tax now? Well, they know that down the road, that timing difference is going to flip, and they'll have to pay more. This liability is basically the company saying, we know we owe this money. It's an IOU to the taxman for taxes they've put off paying. Now, the opposite can happen too. Sometimes, for various reasons, a company actually pays more tax up front than its income statement would make you think. When that happens, they create a deferred tax asset. And you can think of this as an IOU from the taxman. It represents a future tax break the company gets to cash in later to lower its bill. And here's the really crucial point. These things, deferred tax assets and liabilities, they aren't just some abstract accounting game. Nope, they are real, tangible items on a company's balance sheet that give us some powerful clues about what its future might look like. This brings us to a super important question, especially if you're an analyst. That deferred tax asset, that IOU from the taxman, it's only worth something if the company is actually profitable in the future, right? You need profits to use a tax break against. So what happens if the company isn't so sure it's going to be profitable? Well, that's where this thing called a valuation allowance comes into play. You can think of it as the accountant's reality check. It's an account that basically reduces the value of that IOU. It's management's way of signaling, hey, we might not be profitable enough to actually use this tax break. A big or even a growing valuation allowance, that's a serious red flag. All right, we've been on quite a journey here, right? Through 2 sets of books, timing mismatches, and these financial IOUs. So let's bring it all home and talk about why any of this really matters to you when you're looking at a company. So, here are the big takeaways. When you see a large deferred tax liability, that's a signal that bigger cash tax payments could be coming in the future as everything evens out.
On the flip side, a deferred tax asset suggests, hey, future tax breaks are on the way. But, and this is a big but, you always have to check for that valuation allowance. That's the little detail that tells you if management is worried about future profits. Honestly, understanding this one area is the key to connecting the profit a company reports with the cash it actually pays. It just gives you a much richer, more nuanced view of a company's true financial health.
So the next time you open up an annual report and you see that tax expense line, you'll know it's not just a number. It's the final chapter in a hidden story. Now that you know how to read it, what will you be looking for? Thanks for joining us.